The concept of payment shock is this. Anytime your payment increases more than 50% of where you currently are, that's a red flag. But anything that's 0 to 50% increase of where you are, you should be able to absorb and handle that. We have a payment of $1,500 a month. You're paying rent. So 50% of that would equal $750, okay? So what we're saying is you should be able to comfortably afford a house payment that is $2,250. That's the concept. Now, not saying that you can't exceed the 50%, but you really need to beware and understand the rest of your numbers if you're going to do so, because FHA and other entities that insure these loans, they've looked at millions and millions of loans and they found that these percentages are fairly safe bets, okay? From a 10,000 foot view, it's good for you to know how far you should be able to go comfortably and get into a new home. Now, let's think about this logically. The second thing that you should be cognizant of is something that we call residual income, okay? What is residual income? It's your gross income minus your federal and state, if that's applicable to you, taxes, your Social Security or your Medicaid, Medicare. Where do you find this information? It's on your pay stub, your itemized or your detailed pay stub that shows you all of the deductions, okay? But your gross minus these things, okay, minus your current liabilities. I'll just put LAB, or we'll call it bills. Now, where you can get these bills or current liabilities, you can go to your bank statement. I think that's a great place to look. You could go back over 3 months and see what your monthly bills currently are that you're going to have on a monthly basis, the things that are going to show up on your credit report, revolving lines of credit, loans that you might have, student loans. Okay, that's very important. Anything that you have going out on a recurring basis. Also, you guys may have some undisclosed liabilities that you may not know that are undisclosed, things that fall under the buy now, pay later type accounts. But the goal of this exercise is you want to get all of those minimum monthly payments, okay? Now we're going to figure out what your residual income is going to be. So we're going to take the gross, subtract the taxes, your current bills here, and the proposed house payment. And this is including principal, interest, taxes, and insurance. In the South, I'll use the South as an example. If you are a single person and it's just yourself, you should have this amount of money left over. That is a great example of how much money you need to left over. And this is what's called the residual income calculation. This calculation, in my professional opinion, is why VA loans are so successful. Okay, barring any anomalies with humans, because life happens and things happen. But for the most part, VA loans perform very well, even with having financed 100% of the purchase price. Okay, and the reason why is we make sure that the buyer has money left over after having closed on the home, i.e. the residual income. If you have 2 people in the household, $738. This is for folks in the South, because depending on where you are in the country, prices can be higher or lower. But if you have 3 people in the house, $889. Family of 4, $1,038. Family of 5, $1,039. Up to, okay, we'll say up to 2 additional people, or a total of 7 people in a household. But after we get 5, number 6, we need to add $80 per. And then number 7, we would add an additional $80. This is a good example of what you could look at before you reach out to have a consultation, to speak with somebody like myself or the lender that you know, like, and trust, to give you a good idea if you are ready to move forward. Okay, so just to recap, the first thing was payment shock. You should comfortably be able to make a mortgage payment there. That's the first check. Second check, I want to look at my own residual income based upon the calculation that Robert is telling us, okay? And then lastly, the last thing we want to look at is the maintenance. So let's say maintenance, maintenance, the maintenance. This is tried and true. How do I determine how much money I should be putting up for maintenance? And it's simply this. The equation is this: 14 cents per, or times, let's say times, the square footage, the total square footage of the home. Now, each county, parish, township nowadays has an online portal as far as the taxes are concerned. This is Old Travis County, the capital of Texas, the great state of Texas. Go to property search. And then here we're going to hit property search. And then you want to search for the address. Okay. So the house that we just looked at here, what you would do is type in Legend, L-E-End. No, it's L-E-G-E-N-D, Milton. All right. And some of these portals will allow you to put a physical address if you know it. Some of them is going to have you just put the street name. And then over here to the right, you can see we can search for 2023, 2022. As you can see, these are all of the homes on Legend Milton. Here's the point. Let's say that the home address that we were looking for is 1113 Legend Milton Lane, okay? And so you would click on the property ID, and what you're looking for is the square footage. So typically that's going to be under the improvement section. And as you can see here at the very top, it says improvements is a one family dwelling, gives you the improved value based upon the tax appraisal district. And the main area is 1866 square feet. This looks like a two-story, but the gross building area is 4261, right? So this house is 4,261 square feet, and you will multiply that by 0.14. So you would have to have or be comfortable with putting $596, let's just call it $600 a month to the side in your budget for maintenance when life happens, okay? Not if life happens, but when life happens. So if you plan for these things, take the total square footage of your home, multiply it times 14 cents. And if you're comfortable with putting those monies to the side, you should never, let me not speak in absolutes, but you should never have to worry about when things have to be replaced, because see, you're accounting for it up front. And this is how home ownership really is done. And this is why we like to do these types of videos, to empower you. So if you implement those three things, understand what your payment shock is for the new home payment that you should go into. Number two, figure out how much money you need to have left over after all the bills are paid, the residual income based upon your family size, okay? And then the third thing, know how much money you need to allocate on a monthly basis for maintenance for when things go wrong, okay? Because nothing lasts forever. These are mechanical things. And when they go wrong, if you have the money set aside, it's a blessing. So there you have it. Those are the three things: short, sweet, and to the point. For more great information on how you should go about becoming a homeowner, check out this playlist right here. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. And until the next time, peace.